I am AI Avatar of CA Ratan Mundra. Welcome to this detailed analysis of the IFSCA circular dated May 12, 2026 regarding implementation services by investment advisors operating in IFSC. This circular is highly important for investment advisors, compliance officers, broker-dealers, global access providers, introducing brokers, asset management companies, and advisory clients working within the GIFT IFSC ecosystem. Earlier, investment advisors were already permitted to provide implementation services under the IFSCA Capital Market Intermediaries Regulations 2025. However, the regulations did not clearly define how implementation should happen for different categories of financial products. The new circular now provides structured clarity. It explains exactly which channels must be used depending on whether the product is foreign listed, IFSC listed, or unlisted. This creates a stronger compliance framework, improves transparency, and reduces the risk of informal or unregulated execution practices. Implementation services refer to the process of executing or giving effect to investment advice already provided by an investment advisor. In simple words, once an advisor recommends an investment product or strategy, the client may require assistance in actually executing that recommendation. This execution support is called implementation service. For example, the advisor may connect the client with a broker, a global access provider, an IFSC exchange member, or a regulated investment platform. However, the circular makes it very clear that implementation services cannot exist independently. The implementation must always be connected to investment advice already rendered. This means advisors cannot run a separate execution business unrelated to advisory services. Every implementation activity must be traceable to the original advice provided to the client. This clarification becomes extremely important for compliance monitoring and audit trails. Before this circular, the legal permission already existed under Regulation 34 of the IFSCA Capital Market Intermediaries Regulations 2025. Regulation 34 allowed investment advisors to provide implementation services to their clients in the securities market, but certain safeguards were compulsory. First, the advisor had to disclose conflicts of interest properly. Second, any implementation fee charged to the client had to be transparently disclosed and contractually agreed. Third, and most importantly, clients could never be forced to use the implementation services offered by the advisor. The earlier framework focused mainly on investor protection principles. However, it lacked operational clarity regarding execution channels. The new circular now fills this gap by introducing a structured product-wise routing framework. The May 12, 2026 circular does not remove the earlier permission given to investment advisors. Instead, it operationalizes and structures the framework. IFSCA has now divided implementation services into three categories based on the type of financial product involved. For foreign listed products, implementation must happen through a global access provider or an introducing broker located in IFSC. For products listed on recognized IFSC stock exchanges, execution must happen through a recognized exchange member. And for unlisted financial products, advisors must maintain formal arrangements with regulated foreign platforms or asset management companies. This product-wise mapping is the most important material change introduced by the circular. It brings structure, accountability, and better supervision to advisory-linked execution activities. Let us first understand the framework for financial products listed on foreign stock exchanges. Under the new circular, investment advisors cannot casually route execution to foreign brokers or overseas entities. Instead, implementation must happen through either a global access provider or an introducing broker based in IFSC. This is a major compliance change because it aligns foreign market access with the IFSC regulatory ecosystem. The objective is to ensure that all cross-border implementation activity remains transparent, regulated, and auditable. Investment advisors must therefore carefully review their existing execution arrangements and verify whether they comply with the prescribed IFSC structure. This also creates major opportunities for compliant global access providers and introducing brokers operating within IFSC. For products listed on recognized IFSC stock exchanges, the circular introduces another important requirement. Implementation services must now be routed through members of recognized IFSC stock exchanges. This strengthens the official exchange ecosystem and ensures that execution activity remains within recognized market infrastructure. Investment advisors must therefore identify suitable exchange members and establish proper arrangements for execution support. Using non-member channels for IFSC listed products may now create significant compliance exposure. Advisors should also ensure that agreements with exchange members clearly define operational responsibilities, fee structures, reporting obligations, and audit support mechanisms. This framework improves market discipline and strengthens investor confidence within IFSC. The most sensitive category under the circular is unlisted financial products. IFSCA now requires investment advisors to maintain formal arrangements with platforms or asset management companies regulated by a foreign financial sector regulator. This means informal execution support for unlisted investments becomes highly risky from a compliance perspective. Investment advisors must now verify the regulatory status of every foreign platform or AMC before implementation support is provided. This introduces a much stronger due diligence obligation. Advisors should maintain documentary proof of regulatory registration, licensing status, operational credibility, and suitability assessment. Proper written agreements are also essential. This change is particularly important because unlisted products often carry higher valuation risks, liquidity risks, and investor suitability concerns. The circular creates a significant positive impact for advisory clients and compliance officers. For clients, the framework improves transparency and reduces the risk of hidden commissions, unsuitable routing, or opaque execution structures. Clients continue to retain full freedom to reject implementation services offered by the advisor. This is a critical investor protection safeguard under Regulation 34. For compliance officers, the circular creates a structured checklist-based monitoring system. Every implementation transaction must now be mapped against the product category, the execution channel, client consent, fee disclosures, and conflict disclosures. Compliance teams should also ensure that audit trails clearly connect investment advice with the final implementation activity. This advice to execution linkage is now becoming one of the most important compliance requirements under the framework. Although the circular provides major operational clarity, some important practical questions still remain unanswered. For example, IFSCA has not prescribed a standard format for formal arrangements with foreign platforms or AMCs. The circular also does not clearly define the due diligence standards required to verify whether a foreign platform is properly regulated. Another major concern relates to referral fees and third-party compensation. Regulation 34 generally restricts advisors from receiving compensation from anyone other than the client in relation to advised products. Therefore, any commission sharing or facilitation fee arrangement should be approached very carefully. Investment advisors must strengthen their documentation systems, compliance records, client disclosures, and internal SOP immediately. Failure to maintain proper records could create audit, inspection, and enforcement risk. To summarize, the May 12, 2026 IFSCA circular does not create a completely new permission. Implementation services were already allowed under the earlier regulations. However, the circular now introduces a structured routing framework depending on product category. Foreign listed products must use global access providers or introducing brokers in IFSC. IFSC listed products must be routed through recognized exchange members. Unlisted products require formal arrangements with regulated foreign platforms or AMCs. Investment advisors should immediately review client agreements, conflict disclosures, fee structures, vendor arrangements, compliance manuals, and implementation SOP. Most importantly, advisors must maintain a strong advice to implementation audit trail for every transaction. This circular is ultimately designed to create a cleaner, more transparent, and more regulated advisory ecosystem within IFSC. And for the industry, the message is clear. Implementation services are posited, but they must now be structured, documented, disclosed, and fully compliant. Moon Says and Management Consultants LLP, a trusted partner for SEZ and IFSC excellence, a pioneer in establishing SEZ and IFSC units within GIFT City and India, delivering end-to-end IFSC setup, operational support, and handling compliances, risk management. Renowned for deep expertise in regulatory approvals, capital markets, fund management, insurance, finance company, foreign university, BATF, and ancillary regulations and fintech. Expertise in customs clearance for aircraft and ship procurement, leasing, GST, DSPF, IFSCA. Comprehensive support covering registration, reporting, and regulatory transitions, ensuring ring fencing, transparency, and global compliance standards. Join our network. Scan the QR codes below to stay connected with us.